Surya Saha, and welcome to the Insurtech Story podcast, the platform to spread knowledge on insurance innovation, digital disruptions, and entrepreneurship. Our website, insurtechstory.com, and we are available on Spotify, Apple, Google, and Amazon Music. Today, we will discuss on the topic the ethics of automated claims. And for now, I'm delighted to welcome our guest, Brian Falchuk, who is the President and CEO at Property and Liability Resource Bureau. Brian is committed to the insurance industry's commitment to protect people and put their lives back together at the worst moments they face. Brian is an advisor to the insurance industry and former C-level property and casualty insurance and insurtech executive with deep functional expertise in general management, sales and distribution, operations, mergers and acquisitions, claims, growth, corporate strategy, and business intelligence. Besides, he is also a best-selling author, executive coach, TEDx presenter, and public speaker with articles written for Inc. magazine, the LA Times, Chicago Tribune, and many more. Brian, a warm welcome to the show.
Thank you so much for having me on.
So, Brian, as the agenda for the day, we wanted to discuss more on the ethical aspects of automated claims and what the industry is thinking about.
Yes.
I would really want to understand your thoughts on some of the ethical considerations surrounding the use of automated technologies in claims management.
I think there's definitely a need to have this conversation from a few fronts. And I think a lot of it stems from maybe fear or insecurity or perhaps misunderstanding. And also a lot of it, I think we can mitigate or control. So it's good to have these conversations right now. But I think all of us who are maybe concerned or uncertain, we just need to remember just because something is concerning doesn't mean the answer has to be no. And so I would just ask everyone to go in with that mindset is, I heard someone just this week say, but that might be illegal or might be regulated, so we can't do it. And I said, well, our whole industry is regulated. So if regulation is your reason for saying no, then you need to retire because we shouldn't even be in business, right? So let's keep that in mind first, right? And I think AI is actually an area where there likely will be some form of regulation or controls or rules that are imposed upon us. And again, that doesn't mean the answer needs to be no. It just means you have to accommodate for that and you have to work through that. I think from an ethics standpoint, this is where taking a not a wait and see approach, but a test and learn and try in controlled ways approach is the right answer. And the reason is I don't think we have all the answers yet. We don't know all the tools. They're not fully mature. We don't know all the applications of them. But there are certainly areas of our business where we can start to try and we can use them to assist the human decision-making that we have. And that allows for that ethical kind of ethical check or ethical navigation, if you will, before, this notion that the AI is just out there doing things. One of the reasons why I think a lot of people push back is they say, well, there could be bias in it. It may be, taking action against people. And the thing that I find so fascinating about that argument is we are an industry that suffers from that tremendously today. And for some reason, people are comfortable with the wrong that we do right now because it's familiar to us. And I think we have to sort of disabuse ourselves of that mindset right off the bat. In the US in particular, there's a lot of use of credit scores. So, people's financial health as defined by the financial services industry. And it's a strong predictor of risk, but quite often it's totally divorced from the actual drivers of loss. And the things that make it move are very often disconnected from those drivers of loss. And we have ways today to measure the actual impactors of your exposure, but there's a hesitance to use them. And quite often I hear ethics and bias used as the arguments for why we can't do that because we don't know if they're biased or not. Well, we know that what we're using right now is biased. And so to me, that means instead of just standing by it because it's sort of the devil you know, we need to be more accepting of exploring other paths. And I find that to be a very strange argument because not only do we know it's biased, we also know it's not directly correlated to risk. It's a predictor of it. It happens to have a correlation to it, but it's not the direct, like, the roads that you drive on, the quality of those roads and the speed with which other people drive and the accident prevalence on those roads would seem to be a much better predictor of whether you get in a car accident than, whether you grew up financially disadvantaged and therefore, you're sort of stuck in a pattern with bad credit.
Right.
Um,
Yep.
Even if there's a correlation, clearly, if I could know about the actual environment in which you're driving, that would be a far better predictor of your auto physical damage risk than, whether you missed a credit card payment last month. And so that's where I think we need to start to be more open to that. And I know you asked about AI, and I'm talking about data inputs rather than AI, but this same argument applies across the board, and often it's around bias. And I do think we forget how biased humans are. It doesn't mean we're biased against people per se, but it's the way our brains work. We have confirmation bias. Most of these things operate unconsciously. And I came from a claims world. The claim you were just handling, if the next one that you touch has similarities to it, whether you're aware of it or not, your brain is making connections that may not be there. So you're inherently going to take some of the things you were just seeing and bring them to this new file. And AI doesn't have to do that. It has no emotional connection, conscious or subconscious, to the thing it was just doing. So it can be divorced of a lot of the biases that humans suffer from that, yes, may not lead to an equitable outcome, but also may lead to a bad loss outcome for the carrier, where we're paying things we shouldn't be paying, where we're missing fraud we shouldn't be missing, or almost worse yet, we're presuming fraud when there's no fraud present, and mistreating someone as a result of that, and drawing the claim out and maybe increasing the risk that that claimant then seeks legal counsel and brings a lawsuit. I mean, there's so many things that come from it.
Yep.
So I think and I know this is a much longer answer than you probably wanted, but we do just need to start with this notion of what we're doing today is not perfect, and we can try things and test them. We don't have to just say no because there may be complications to it.
Yeah. I think you have mentioned, couple of points on having some checks, and also you mentioned about potential biases, right? So
Yeah.
what are the potential biases and challenges that may arise when relying heavily on, algorithms for claims assessment and settlement? I mean, insurers increasingly they are, bombarded with data on a daily basis, right? And the more and more automations, analytics they're trying to use, invariably there comes, the algorithms and any such codings on that goes behind the screen. And when you are exposed to more and more of such data and related technologies, you really tend to get a little bit biased and, challenged to what to be done, what not to be done, or how to get things done.
Yeah.
So what's your views on that?
Well, so I'm when you ask the question, I'm immediately reminded of a specific example of a carrier who they're a more conservative carrier. They're in a more conservative area, traditional values, more rural. They insure a lot of farm owners and properties tied to farms. So for them, a lot of the excitement around AI was uncomfortable. Either
Right.
directly, or they thought, their agents were not comfortable with it, their insureds were not comfortable with it. But they also knew we can't sit here and just say no because someone may be uncomfortable, because by the time it becomes a non-option where you really do need to be using these tools for better underwriting outcomes, it'll be too late for us to start to learn. Our business will have eroded underneath us by then. So they recognize we do need to start to play around with this in safe areas and in safe ways where we can still control for the things we're concerned about, but get smarter about it and build the technological capabilities in terms of, microservices and APIs and bringing in third-party data and having different data models internally and making sure our systems have the flexibility for all that. And so what they decided was they worked with a particular AI-based predictive modeling company that uses behavioral science and
Yeah.
external data tied to your underwriting and claims data to try to predict people's propensities to do certain things. And I mean, that's the nature of insurance, right? We're trying to predict the propensity of a loss.
Yeah.
But here it gets down to, or can get down to, very granular things. And what they ended up using it on was wild. They used it to determine whether someone was likely to have a wood burning stove in their home. And I know people who are all excited about AI. They're like, that is the last thing I would have, like, that never would have occurred to me. Like, why would you use it to tell, if someone has a wood burning stove in their house? Um, but that causes house fires because they're often not, they're not maintained appropriately. They build up soot and ash, something called creosote, and actually they're responsible for not just house fires and total losses, but deaths, quite a few deaths every year. And so finding out if an insured has one of these in their home is really critical. And people often don't report that they have them, or maybe they bought their policy and had it installed later and they didn't know that they needed to go back to their insurance company and tell them. So you're undercharging and you're taking on a pretty material fire risk and death risk that you didn't know about. So they use the model to try to predict amongst the people who did not report having a stove, what's the likelihood that they have one. And they were
Yeah.
able actually to identify this population. Now, if they were fully bought in on AI, they would say, okay, well, the model's just going to change the rate and, jack these people's insurance prices up or just cancel them. But that didn't sit well with them. They thought their agents would be upset about that. So instead, they made it part of their annual renewal process where they asked some questions. They asked about the stove. And in particular, they asked for those people who the model identified a high likelihood of having one. And if the person didn't respond to the survey or didn't check the box that they have a stove, but the model says they likely do, they would then have an underwriting assistant follow up and call the insured and talk to them about it. And what they were trying to do is, one, find out if there was a stove, and two, not just raise people's rates, but talk about the risk management side of it, ask about the maintenance of it, because they can be safe. You just have to use them right and maintain them right. But it was it was the AI to identify, but then a human made a decision and did the outreach in an empathetic and caring and risk reduction based way, instead of you just wake up one day to a letter that says your insurance is going up $800 a year, or you will be canceled in 30 days.
Yeah.
And so that I think is an example of that difference of how we can choose to navigate this and make sure that we're designing these processes in a way that actually feel comfortable to us and the people on the receiving end and our partners around them as well. Because obviously, if an agent saw you doing that to one of their customers, they'd probably stop writing business with you, because that puts the agent in a very difficult situation.
Yeah.
So you have to navigate these things appropriately. And the thing is, we can. It doesn't have to be fully automated and just, well, the machine said I have no say over it. You can't just blame the machine. So there are ways to do these things.
Yeah. I think you mentioned about behavioral science, and it's very interesting how it relates to insurance claims. Actually, if I can recall rightly, in 2016, if not, I think it was Lemonade or something, where in their platform, one of the customers actually recorded a video to actually, inform or demonstrate that the person has lost some $1,000 of goods, or rather it was stolen, and
Yeah.
what claims can be, done for him or her. And I exactly can't recall the entire narrative, but it actually relates to how the how machine human interaction and how such of behavioral aspects can be taken in consideration to process or rather evaluate any potential claims.
Yeah, and that's different from just taking a written statement
Yeah.
or having
Yeah.
you fill out the fields in an app, because now you can study what's going on with their face. There's more that you can verify with it than just a written statement. And
Yeah.
I mean, we see these things more and more. Lemonade's an interesting case. However, I don't write them off because of that. I'm not sure that they could survive. They have a lot of money, so it's possible. But whether they survive or not, or whether they're a bad underwriter or not, there are all these other things that they're doing that I think are quite interesting. And when I see people writing them off, and I do as well, I'm very quick to remind them, just because they may fail doesn't mean what they're doing is stupid across the board. And what if you took these aspects of their business that have nothing to do with their underwriting results, their marketing skills, which are fantastic, the way they're taking first notice of loss, et cetera. What if you put that along with your underwriting capabilities that are profitable or are more sound? Then where do you get? So we need to be careful about just, oh, that's hype, or yeah, but they're terrible underwriters. They're going to probably write around a 200% loss ratio or combined ratio this year. Not viable. But that doesn't mean everything they're doing is wrong. And I think we need to be more open to that.
Right. Yeah. So, Brian, the last, question that I have for you for today is, how do you strike the right balance between efficiency and fairness, ensuring that, automated systems don't compromise the rights and experiences of policyholders?
Yeah. Well, I think the easy place to start is to automate pieces of the process that are internal, non-customer facing, and are taking away your people's time and skills from providing actual service and making critical decisions. And even with all the RPA and other automation people have been doing, we still have a lot of process mud that we could clean out. So I think there's still quite a ways to go. At the same time, I think there's an over focus on efficiency in the industry. And I say this as a former management consultant, as someone who loves lean, and I'm not anti-efficiency, but even if you were to remove 100% of the expense ratio from every carrier, many carriers, especially right now, would still be losing money this year. It's not about the expense ratio. It's not about the efficiency. It doesn't mean ignore those things, but that's not really where you should be focusing your efforts. It's the payments. We have to get to better indemnity outcomes. That means fair, because fair claim payments get settled faster and closed faster with less likelihood that attorneys get brought in. And that's what leads a seemingly innocuous claim to become a severity moment. But also making smarter choices on the more contentious claims. So we have to address indemnity over efficiency and expense, or we will continue to be hammering and spending money in the wrong area and wondering why we're not making any progress. I mean, the industry's been investing in the expense ratio for decades, and it's effectively unchanged. So I would love to see us wake up and realize the money is on the indemnity side. That's better underwriting decisions and better claims decisions, not just about taking people out of the process or, carving like micro percentages of expense percentages off the table. That's, there's I like an efficient process. I don't think we should be wasteful. And there's tons of that right now. But honestly, we're never going to get the expense ratio to zero. Even just for paying commission or marketing expenses, we're going to pay something. So even if you could fire all of your staff and pay nothing for customer acquisition or electricity or anything else, which is obviously impossible, you still are going to have a problem with your loss results. So we need to be focusing on indemnity, the drivers of it, and the management of it. And anything else is very nice, but I think we've got the wrong focus as an industry. And for some reason, we have not woken up to that after decades of doing the wrong thing.
Yep, absolutely. I think, striking the right balance is certainly crucial, and especially where technology is actually there, not to replace, but aids human decision making rather than, replacing the entire mechanism of the system. And it's imperative for insurers to invest in robust algorithms, create audit mechanisms, and kind of an ongoing evaluation to mitigate all sort of biases and ensure the ethical handling of claims is in place, where customer trust and satisfaction is established. With that, thank you very much, Brian. A fantastic discussion. Thank you for sharing your thoughts today, and a true delight to have you as a guest.
Thanks for having me on.
And lastly, to wrap this up, thank you for listening, and see you at our next episode. Take care and stay safe. Goodbye for now.